Management teams of target companies to be purchased by private equity sponsors have to understand that they are going to be asked to invest their own capital, their own money into their transaction. So the most important thing for them to focus on is to ensure that that equity receives the same rights as the equity that it's being received by the private equity sponsor. It's the classic cliche that everybody should have skin in the game. So the concern, if you don't require management to invest, is that the private equity sponsor, who themselves have investors, are sitting there on a huge pool of invested capital where the management team can at any point in time kind of decide, I'm out of here. And really at the end of the day, private equity sponsors are investing in a management team. So the alignment of interest is fundamentally starts at the requirement that the management team invest their own money and stand side by side with the other investors. It used to be that there were a number of different tax efficient ways where that money could get invested or rolled over on a tax-free basis. Unfortunately, due to the change in the tax laws, that becomes very problematic in most typical structures. So really the only tax efficient way for the management team to reinvest their money is receive their proceeds, pay their taxes on that money, and then invest on an after-tax basis. So the overall compensation package for senior managements of a private equity invested deal, in addition to the money that they're going to have to invest and the cash compensation that they're going to receive, they'll also generally receive two forms of equity. One is strictly time-based, which is the more common form of equity, which basically says that you will receive a certain additional points in the deal, equity ownership, and that will vest over time. Performance-based is equity that you receive only if the company achieves certain objective performance metrics. Typically, the allocation of that incentive equity is anywhere from 50% time-based to 50% performance-based to 1/3 time-based, 2/3 performance-based. It's really a function of deal by deal and negotiation.